Good morning, all. So my name is Callum. I'm here today representing UK Finance, who are the trade body representing 300 lenders across the finance and banking industry. And within that, we represent over 100 lenders in the mortgage space across pretty much every type of mortgage lending, from your mainstream ring-fence banks right to your lifetime specialists. And I think this is just a point I want to make right at the start. We're talking here not just about lifetime, but about, again, the later life mortgage market as a whole. As was mentioned, we have just launched a new public quarterly release, and I want to use some of the data today from that to look at the full later life mortgage market and how it's changed in recent years, and answer these three key questions. Where's the market heading? How is it currently behaving? And what sets apart the different products in the space? First of all, though, I do want to just quickly go over some sort of underlying assumptions when I was putting this together. First of all, we can't just look at trends at a high level, given the complexity of the market, as you're all well aware. It is, there's so many different products offered. There are so many different types of borrowers who need, all sorts of different sets of circumstances. So it's really important to segment and break things down. And then when we think about how we actually approach the market, lending in later life, there are 2 points I wanted to make. First, we need to be thinking about products across the whole market and how they affect one another. So, for example, if there's a change to how pensions work or how people are using their pensions, we need to think about how it's going to affect different parts of the market, not just mortgages, obviously, but also vulnerability, etc. And then as an industry, we do need to be putting our best foot forward and working collaboratively to ensure that we're working towards a thriving market that works for everybody in the future. And I very much do believe both these things are happening at the moment. I'll give you a couple of examples on the approach and making sure everything is connected. Very much seeing across the industry, when we're doing stuff like I've forgotten the word for it. When we're looking at consultation responses for policy changes, you very much see the lenders, trade bodies, all taking into account how this will impact different parts of the market. And on the collaboration point, and this is a document I'll come back to later, but we did just publish the later life mortgage leaflet between ourselves and 4 other trade bodies, and I'll return to that because it is an important point I want to make. So I'll start then with that first question: where is the market heading and why? Again, this is something that was covered earlier, so I won't go into very much detail at all here. Yes, the population is aging. It's going to go from the number of borrowers, the proportion of borrowers aged over 65 is going to rise from 31% to 38% in the next 40 years or so. This is obviously looking into the far, far future. But it is important when we're looking at later life that we do look this far ahead. So this is obviously clear again, not just on the mortgage piece, but on the piece across the whole market. That we need thinking about how we can assist people when they get to this stage, and also beforehand in terms of education and making people aware of, not just, for example, having equity in their home, but also vulnerability, pensions, etc., all that stuff. Again, not new ground, so I'm going to move on to mortgages. And this is sort of one of the big headline figures from one of our recent releases in the later life space, which is, as you can see here, borrowers for new mortgages, those mortgages are going to end at a later stage in that borrower's life. So for 2021, at least for the first 3 quarters, we saw that 50% of all new mortgages will now end past the borrower's 65th birthday. And clearly, this is a big deal. The potential impacts of this are significant. More borrowers may need support if they still have a mortgage when approaching later life, especially if they're paying more into their mortgage and less into their pension, which was a point made earlier as well about pensions. But you may look at this chart and think, well, surely this is just driven by borrowers now getting older rather than anything else. And yeah, okay, the age of borrowing has shifted upwards very slightly, but not significantly enough for that to be the driver here. The driver here is actually mortgage terms getting longer. So as you can see here, in the past, the 25-year mortgage was very much your bread and butter mortgage. It was, the most common. I think it was 80% of mortgages were at a 25-year term or less in the past. But now you can very much see that not only have we got mortgages surpassing 25 to 30-year terms, but actually going beyond that 30-year term as well. So this is what's really driving that behavior that we saw. And I know you might be thinking, well, okay, that's great, let's move on. But actually, I do want to get into why this is happening. It may not seem super relevant because this is new lending ultimately. But again, that point about making sure everything's interconnected and understanding how everything impacts everything else, I wanted to cover it here. So mortgage terms getting longer are driven by tightening affordability in new mortgages. Stretching the mortgage term has been one of the few ways to keep a mortgage affordable, allowing the borrower to lower the monthly costs of mortgage affordability, but of course that means they will pay more over the life of the mortgage, and it means that the mortgage will, as I said, will end later, in this case into later life. So yes, the idea of more borrowers still having a mortgage by age 65 may seem like a cause for concern, but there is already significant infrastructure in place for the later life market. There's continued focus on this area into the future. Obviously, we're all here today. And lender underwriting ultimately means that these mortgages will be affordable for the entire duration of them. So borrowers who are borrowing for longer will still be in good standing when they reach the end of the mortgage, but also able to get the support they need tailored to their circumstances, should that be necessary, so accessing property equity in a suitable way to support them in retirement. So that's the first question I wanted to cover, which is, as I said, where is the market heading and why? So ultimately, we're going to very likely see a real increase in volumes, not just in lifetime, but across the whole market in general. And it's driven by two things: borrowers having their mortgages end later, and an aging population. So let's move on then to that second question, which is how is the market currently behaving and why? So this is volume of mortgages to borrowers aged 55 or over split by product. As you can see here, when you look at just the totals, so without looking at the volumes just at the split just yet, we have seen a rise in the market. Broadly speaking, this is across every product here on this page, but obviously there'll be different reasons, particularly when we look at mainstream versus specialist, i.e. lifetime on this chart. Much of the recent activity in 2020 to 2021 on the mainstream side was obviously driven by stamp duty holiday, encouraging borrowers to move or purchase additional properties. We did see quite a lot of equity used in existing properties to fund second homes, be it buy-to-let, be it holiday to let, be it funding first-time buyer deposits for their kids. So we saw a lot of that in the mainstream market, and ultimately that led to older borrowers making up a significant part of gross mortgage lending last year, demonstrating that the wider market is very much open for mainstream lending in later life. I will very briefly just touch on lifetime mortgages here, although obviously I'll come back to them later because they are a really big part of the market. Yes, we did see some lower lifetime volumes specifically in 2020 to 2021, when you compare it to the 2 years previous. This was very much in part due to borrowers looking for certainty, as again has already been covered. But these reductions in volume are relatively low, and the market is still in a much stronger place than it was in 2014, for example. with plenty of borrowers looking to continue to access equity throughout the pandemic, and as I say, that's only going to become more of the case in the future. So yeah, I did just want to make that comparison between mainstream and specialist later life before moving on. So let's look at age of borrower. So it's clear here that the younger parts of the later life cohort, so your 55 to 65-year-olds, are driving the market in terms of volumes. Although, again, we have seen substantial increases in activity for every age group over the past 7 years, as shown here. But borrowers over 65 are actually using the market in a different way. So 55 to 65, the majority of your lending is going to be your mainstream products, your house purchase, your remortgages with equity or just product transfers, etc., or buy-to-let. And a tiny bit of lifetime, but not a huge amount, especially compared to the over 65s, which I'll just cover now. So this is over 65s, and this chart goes a lot further back. And the reason for that is I kind of wanted to make a comparison here. You can see sort of pre-2009, there was a much bigger split between lifetime and mainstream, or specialist and mainstream, about a 50-50 split of mainstream products to your lifetime, although here I'm just using lifetime as an example of a specialist product. But more recently, from sort of 2009 onwards, you can see that lifetime is very much the dominant product here. And that is by and large due to the main thing that has been driving lending in those older borrowers, which is, of course, equity. So I will move on to equity. So obviously, house prices have been increasing significantly. The average house price now is almost 250k. Obviously, in London, it's a lot more, and in the south as well. So equity positions for borrowers is becoming stronger. And again, when we talk about sort of the increases in the last 5 years, you can see that house price increases in just that time have been really significant, and encouraging more borrowers to look to access equity to help them with retirement or for any other reason, i.e., taking, as I covered earlier, taking out money to get a second home, etc. So we'll have a quick look at equity stakes then. Again, this is not going to be super surprising for anyone in here, but I think the main comparison I wanted to make here is, looking at older borrowers versus sort of your younger borrowers and why there's been that real uplift in equity here, and in lifetime especially for your older borrowers. In terms of the whole market, I'll just quickly give you a statistic from our household finance review last year, which is actually in the UK in general, equity is strong. About 50% of mortgage holders own at least 50% of their home. But obviously, for older borrowers, that's much stronger, and this is obviously just for mortgages. When you look at, as was covered earlier, people who own their home outright, they've got a lot of equity to take advantage of. So again, it's in a really strong place, and it's one of the drivers for those older borrowers taking out equity, be it for retirement or otherwise. So that's the second question I wanted to answer, which is how is the market currently behaving? Ultimately, across the market, we've seen growth driven by rising house prices, both on the mainstream and the lifetime balance. 55 to 64-year-olds generally access mainstream products, and borrowers who are older tend to access specialty mortgages such as lifetime. So I've done a bit of dancing around lifetime, so now we'll talk about mortgage products in the space in general. So we'll start on lifetime, of course. Again, not going to go into a lot of detail on lifetime, just because obviously it's going to get covered a fair bit later on. But there's a couple of points I want to make here. Obviously, you can see that there's been a real increase in the last 16 years or so. And part of that isn't just, it's not just equity. I mean, equity is obviously a big driver here, but it isn't just equity. It is that real push on expanding the products, on the market becoming more competitive, the huge amount of flexibility that's now available. There has been real innovation in this space, and that is a really key part of why Lifetime is the most popular product here, and will likely continue to be for years to come. I do want to quickly just address the teal 55 to 60 category. Obviously, this has been highlighted before as sort of an area to watch. I will just say that the volumes continue to be very low, and you know, borrowers are taking these out in their own best interests, as the lending rules ensure. So this is very much, you know, not a cause for concern in my view. I'll stick with Lifetimes, just have a look at the regional picture. This won't be very surprising, but it's not something we usually get to share, so this is new for us. And I've compared here 2006 to 2021. Unsurprisingly, you can see that the South is seeing the biggest gains in volume. This won't be much of a surprise, as I've said. Equity positions in the South and in London are huge. House prices in London have doubled over the past, I think, 10 years. So again, no real surprises. I'll address, obviously, in areas where there are lower house prices or where equity stakes are not as strong, you do sort of see less growth in this sector. But we have seen growth pretty much unanimously across the UK here. So a positive picture, I think, on the Lifetime front. All right, so now we looked at Lifetime, let's have a look at sort of all the different products, and I wanted to break these down by repayment type, essentially. And the reason I wanted to do that is, as I said earlier, it's similar to how we feature lending in general in the Later Life Lending leaflet that we launched in October 2021. This is a consumer-facing information leaflet which provides an overview of the later life market and how it operates. This leaflet was delivered in partnership with the Equity Release Council, Association of Mortgage Intermediaries, Building Society Association, and the Investing and Savings Association. So a real collaborative effort on that part. So within that, Lifetime is clearly the dominant product, as I've already mentioned. You can also see that capital interest mortgages are continuing to be used, probably most likely for sort of mainstream purposes, as you'd expect. You can see that there's been a considerable amount of change in the makeup of the market since 2005, particularly obviously interest-only. New interest-only mortgages have declined significantly, as you'd expect, and for reasons well known. Of course, I'm going to talk about RIOs. RIO mortgages, there's been a lot said about them since they launched in 2018. The FCA recently stated that there's only been about 5,000 completed since they went live in 2018 Q3. And as you can see, the volumes in comparison to everything else are tiny. I do have a slide here on why there's been such a limited number completed. I thought that the answer earlier about RIOs was really interesting and very much covered a lot of this ground already. It is my view that affordability tests are really the main driver here. You know, as you will have to check both borrowers, and one borrower may be deemed not to have the affordability criteria. Ultimately, this is due to a separation of mainstream and lifetime lending handbooks. If these were closer aligned, then you would be able to allow the borrowers to move on to a borrower who's remaining that isn't deemed able to afford the mortgage, to move on to a lifetime at that point. But that's not something that's allowed within the affordability checks. So that for us is the key driver here. But I am going to come on to that point about different products and the competition, because RIOs were ultimately launched as something that would allow people with an existing interest-only mortgage to move on to, so they could continue to live in the property until they no longer occupy it. But it's not obviously being used all the time for that use, quite often because it's just not possible under the affordability checks. So I did want to have a look and a comparison between mortgages and how in the space and how they compare. And as you can see, RIOs are very much being used in a really similar way to capital interest and also to lifetime as well, in terms of how they all stack up. There won't be any surprises here, and you can very much see those kind of signifying traits here on your average loan size for interest only is obviously much higher. Your average LTV for lifetime is lower. Your average age is obviously always around 70. And you can see that interest rates are really competitive here, as again was already mentioned. RIO lifetime very much aligned on that mark. So, all these products have their own kind of signifiers, but RIO doesn't really have its own unique characteristics. And I think, part of that is very much affordability, but also, where does it fit in the market, and it being used really as an alternative to lifetime or to capital interest where appropriate. But so that's very much a part of why volumes are low, although affordability for us is the big driver here. So lastly, I do want to just touch on interest-only outstanding, because this is just something that always comes up. It's always sort of something we need to keep an eye on in terms of, monitoring these legacy loans that have been around since before 2010, and just, making sure that borrowers are, repaying, etc. So, and coming off them smoothly. So as you can see here, the news is very good. The interest-only stock has declined significantly in just the last 5 years, and it's continued to do so at a steady pace. And you can also see here for older borrowers, so the yellow and the red, that borrowers are this cohort has shrunk massively as well, and I'm sure will continue to do so. And it's really pleasing to see that interest only has continued to shrink during the pressures of the pandemic, and there have obviously been schemes to help borrowers with interest only should they need the help during the pandemic. So this is a really promising picture for me, and a good place to kind of end things. So on that final question of what breaks down different products, you have your lifetime, which is the most popular product in the space, which is used to give borrowers full access to equity in their homes with great flexibility. You have your RIO mortgages, which are obviously intended to be a product for borrowers on interest-only mortgage, looking to switch, but there are low volumes due to affordability criteria, and ultimately they are used for other uses. You have your capital and interest, which is just essentially your mainstream product for all the borrowers. Again, they'll be using it for stuff like new purchases or equity withdrawal, but at very low volumes and not at the same level that we see in the 55 to 64-year-old category. And then you have your interest only, which is, again, another mainstream product with a repayment plan in place, but there is now very limited popularity in new interest-only mortgages, and the stock of these is shrinking very steadily. Okay, so I'll just quickly summarize then. So yes, the later life market is in a really good spot. Got plenty of demand in the future, driven by aging population and longer mortgage terms ultimately. Lending levels are healthy. In fact, I'll go beyond healthy and say quite strong in the present, driven in part by rising equity, increased consumer choice, and a competitive market across both mainstream and later lifetime. And the products available in the later life market allow borrowers to be flexible and pick the right choice for them, delivering a successful market that will continue to grow in the years to come. So that's all I wanted to cover today. I just wanted to give a quick plug, obviously, couldn't not. You can find more information on our website, both within the latest Later Life Mortgage Lending Quarterly Data Update and the Later Life leaflet that I mentioned as well. I'll now open it up to the floor for questions.